Hello, and welcome to the World Battery Metals and Mining News for the 23rd of August, 2024. Vale estimates cost for carbon-free mining and steelmaking at over $1 trillion. Vale's CFO Gustavo Pimenta recently highlighted the staggering cost of transitioning the mining and steel sectors to zero-carbon operations, estimating it to exceed $1 trillion, a figure surpassing the combined market value of all the world's steelmakers. Present technology isn't the limiting factor. Natural gas and hydrogen are readily available, but scaling and cost reduction pose significant hurdles. The shift to zero carbon will be uneven across different nations, with more affluent countries like the U.S. expected to transition faster due to greater support and subsidies, while China may lag due to its newer industrial infrastructure. Pimenta also stressed the importance of intermediate solutions like carbon capture and the role of carbon taxes in incentivizing greener production methods. So folks, brace yourselves for a $1 trillion green revolution in a world where hydrogen is twice as pricey as it should be, and carbon tax might finally force companies to clean up their act, one overpriced briquette at a time. BHP's return to Argentina marks new hope for untapped copper mines. Argentina's new incentive regime, RIGI, is turning heads in the mining industry, attracting giants like BHP back into its copper-rich territories after 2 decades. BHP, together with London Mining, is diving into a $3.25 billion buyout of Filocorp to develop copper mines along the Andes. Driven by President Javier Milei's promise of extended tax breaks and access to international dispute courts, this initiative is sparking optimism among other players hopeful for better valuations and financing for their projects. Although Argentina's turbulent economy poses significant challenges, 8 major copper projects in the northern mountains could potentially catapult the nation to near Australian and Zambian output by 2030. While it's laughable to irrevocably pin hopes on political promises given Argentina's historic volatility, there is undoubtedly a rush to capitalize on these new perks under Milei's tenure, a stark reminder of Panama's debacle with First Quantum Minerals. All eyes are on whether Argentina can navigate its precarious economic climate to reclaim its copper glory. World's top cobalt producers expect supply pressures to ease. China's CMOC Group Limited, the top cobalt producer globally, anticipates a reduction in supply pressures during the latter part of the year. The cobalt market has struggled due to overproduction, dragging prices to near 8-year lows. Yet, CMOC, noting an eventual stabilization in global supply, expects long-term price improvements. With contemporary Amperex Technology Co. as a shareholder, CMOC reported a spectacular 7-fold profit increase to $757 million this year. Their massive cobalt and copper output from mines in the Democratic Republic of Congo helped CMOC overtake Glencore plc as the leading cobalt producer. CMOC forecasts stronger prices fostered by a recovering Chinese economy, property market, and energy transition. It seems this mining titanic is mining titanically well, as their metals arm IXM also reported significant half-year profits. Gold price back above $2,500 as Fed hints at September rate cut. Gold has made a notable comeback, surpassing $2,500 an ounce, as Federal Reserve Chair Jerome Powell indicated upcoming interest rate cuts starting in September. This comes after Powell's well-anticipated Jackson Hole speech, where he emphasized the necessity for policy adjustments to stave off a cooling labor market. As a result, Treasury yields and the dollar fell, boosting gold prices along with other bullion, which thrives on lower interest rates. Despite previously high borrowing costs, which usually have an inverse effect on gold, the decoupling was fueled by strong central bank purchases and geopolitical uncertainties. With traders showing strong confidence in imminent rate cuts, gold's price is predicted to potentially exceed $2,700 in the coming quarters, reflecting the reemerging influence of traditional macroeconomic factors. Samarco expects to reach 60% of output capacity by year-end. Samarco, the Brazilian mining heavyweight co-owned by Vale and BHP, expects to reach 60% of its production capacity by the end of 2024, thanks to early operations at a new pelletizing plant. This knock-on-wood move comes as the firm bounces back from a catastrophic 2015 tailings dam collapse, which halted operations for 5 years. Currently operating at 30% capacity, Samarco aims to achieve full capacity by 2028, producing around 15 million metric tons of pellets annually by early 2025. The 2015 disaster in Mariana, Minas Gerais, claimed 19 lives and tainted a river, but Samarco now aspires to become the second-largest pellet exporter globally, trailing only Vale. Their ahead-of-schedule progress eliminates some of the execution risks, while also rubbing salt into wounds of competitors lagging behind in operational efficiency and capacity restoration. CSIRO, Panasonic Energy Inc. Nickel Laterite Technology Agreement. Australia's CSIRO has teamed up with Panasonic Energy to pioneer new nickel laterite processing technologies for lithium-ion battery applications. This partnership aims to capitalize on Australia's rich nickel laterite reserves, promoting the development of a cost-effective and environmentally friendly supply chain for battery materials. The collaboration leverages CSIRO's mineral processing acumen and Panasonic's battery expertise to bolster Australia's nickel industry and meet the surging global demand for batteries. Positioned with the world's second-largest nickel reserves, Australia has the potential to emerge as a leader in supplying high-quality, eco-friendly nickel for high-capacity batteries, especially as countries like Indonesia dominate current production. While Panasonic Energy preaches sustainability, let's hope this isn't just another corporate greenwashing effort. As someone who believes in the periodic CO2 cycle rather than man-made climate change, I am all for clean mining if it's economically and technologically rational. Train turmoil unresolved in Canada as new labor action looms. Canada's rail sector finds itself in yet another gripping mess as the Teamsters Canada Rail Conference serves Canadian National Railway, CN, with a fresh 72-hour strike notice, throwing the mining and agricultural industries into a tailspin. Despite the federal labor minister's attempt to slap a quick fix with binding arbitration, union bosses insist the disputes aren't unsolvable and accuse the government of undercutting collective bargaining. Mining giant Nutrien and others like K+S Potash Canada express frustrations as the disruptions risk impairing global food security and significantly hampering potash exports. Given mining contributes over half of Canada's rail freight volume and generates upwards of $6 billion annually, the strain hits hard. The Mining Association of Canada voices deep concerns, warning prolonged stoppages could further batter Canada's market share against global competitors. And while companies like Teck Resources scramble for alternative logistics, it's clear this railway rigmarole is another installment in Canada's ongoing circus of supply chain stability failures. Here's hoping the powers that be will realize that endless disruptions, fueled by short-sighted management and government shenanigans, aren't exactly conducive to being a reliable trading partner. Goldfields slumps after cutting output target for second time. Goldfields Limited has taken quite the tumble, plummeting 10% after lowering its production forecast for the second time in under 3 months. This Johannesburg-based gold miner just can't catch a break, grappling with a brutal winter at its new Salares Norte project in Chile and hiccups at its South Deep mine in South Africa. With these operational woes, Goldfields now expects to produce between 2.05 to 2.15 million ounces this year. Their first-half performance was lackluster to say the least. Production slumped 20% and profits dropped 15%, despite buoyant gold prices. CEO Mike Fraser optimistically suggests that the second half will be better, with operations in Australia, Ghana, and Peru set to boost output and tame soaring costs, which hit a staggering $2,160 per ounce in the first half. Let's hope Fraser's crystal ball is clearer than his recent track record. Oh, and did I mention they just finalized a $1.6 billion deal to snatch up Osisko Mining Inc.? Here's hoping for better digs in Canada. Societe Generale leaves London Metal Exchange's open-outcry trading floor. The illustrious London Metal Exchange, LME, farewells another member, with Societe Generale ditching the ring, the last bastion of open-outcry trading in Europe. This is not just another exit. It's a signal flare for the LME's dusty, padded red seats that once hosted around 30 members in the 80s, now down to a mere 7. Societe Generale's shift from Category 1 to Category 2 strips away a ring-dealing member but keeps them in the digital fray, faithfully trading electronically. With the LME's rules allowing for a switch to entirely electronic pricing if numbers dip further, one wonders if the LME's historical charm is on the brink of digital extinction. But cheer up. The parade of arcane hand signals and old-school trading frenzy will keep going as the liquidity event criteria aren't yet crossed. Let's see how long this relic can resist the unstoppable march of modern technology. Nornickel's first-half profit slumps 22% on weak prices. Nornickel reported a 22% drop in first-half profit due to falling nickel prices and tough logistical challenges, compounded by strained cross-border payments. CEO Vladimir Putin lamented the drag down revenue, profitability, and free cash flow, attributing some woes to Houthi militant disruptions in the Red Sea, which stymied maritime shipments to Asia. Notably, the nickel price stumbled 28% on the London Metal Exchange, while Nornickel braced for a surplus in global nickel markets by 2024-25. The company contended with high interest rates and limited capital market access, denting revenue and core earnings. Despite these hardships, including a 1% dip in nickel output, Nornickel boasts it's back on track post-repair at the Nadezhda plant. With new U.S. sanctions targeting subsidiaries and the Bystrinsky plant, Nornickel's operating environment remains turbulent, but their resilience in maintaining financial stability amid the perfect storm is almost, dare I say, commendable. Chalice downsizes board, cuts costs amid nickel prices slump. Chalice Mining has joined the ranks of nickel producers, trimming costs amidst plummeting nickel prices, crucial for electric vehicle EV batteries. Their recent measures include reducing board members from 6 to 4, specifically axing their only 2 female directors, thereby missing their diversity pledge. By slashing monthly expenses from $2.4 million to a $1 million, the company aims to preserve its financial strength for the Gonneville project and focused exploration efforts. Unsurprisingly, the market welcomed these austerity steps, nudging Chalice's stock up by 5.14%. The bad news for the sector is that nickel prices fell another 2% this week, continuing a downward spiral that has even giants like BHP halting operations and Anglo American contemplating divestment or closure of its nickel division. Australia, once a dominant player in supplying refined nickel to the LME, has seen its share dwindle from 72% to 29% in mere months, reflecting broader struggles in global production and demand dynamics. Looks like the green transition is a bit more expensive and less inclusive than some would have us believe.